For more, let me bring back in economic strategist Frances Newton. She is the Chief Investment Officer for Tuttle Wealth Partners. Frances, welcome back. You and I have been talking about, this latest data all morning long. What did you make of the latest report and what you took away from it as it pertains to the overall health of the economy right now?
Yeah, two things. So first of all, the CPI dropping is the volatility in oil prices around the Strait of Hormuz and the Iranian war. Gasoline prices dropped 9.7% after we thought that there was a ceasefire. Oil is up 13% last week on the no ceasefire because they've reignited tensions in the Strait of Hormuz. So that's going to continue to be volatile in CPI. The core reading was pretty flat, but commodities prices had been selling off, which means there's a quelling of demand in the economy. And the economy is softening a little bit. And so that's what you're seeing the difference between the volatility in the war news versus what's actually going on in the backdrop of the economy.
Yeah. And speaking of the war, I mean, we touched on this earlier, the fact that tensions are ratcheting up as of this week. So these new numbers don't, factor in or bake in the fact that the war has just restarted. What kind of impact is that going to have on next month's report and prices that we're all paying moving forward?
Yeah, very hard to say because it's hard to say how many times this is going to go back and forth. But we can see that oil prices are up again this morning. The 10-year never really went back down to pre-war levels. The 10-year reflects the cost of capital, and that is going to have a lagging effect, but it's going to eventually trickle into all the pricing mechanisms, and it's also going to trickle into affecting balance sheets and earnings. It's just not going to happen overnight. So that's the thing to watch, and I think that's why Kevin Warsh didn't declare victory on this soft reading, and he said that really that was his priority, was to mitigate inflation.
Yeah. Let me play some sound from that. President Trump, he took an Oval Office victory lap after the numbers came out yesterday, but Kevin Warsh said not so fast. Take a listen.
But the report was incredible. Inflation is way down. That means prices are coming way down, and we're doing a great job.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Yeah, what do you make of the disconnect? And is there one view that you agree with more than the other, Frances?
Well, I think what Warsh is saying is there are long and variable lags to monetary policy. There are long and variable lags to so many things. So a third of CPI is owner's equivalent rent. Owner's equivalent rent has many months of a lag in how it affects CPI. And that's those are the numbers, they look at PCE, they look at core, but these are the numbers that he has to look at to determine what to do with rates. Mechanically for your viewers, he's got kind of three ways to kind of quell inflation. One, they can raise the reserve requirements, which just takes the existing money in the system and puts it in the bank reserves, and there's less circulating around the economy. They can reduce the balance sheet, which reduces the aggregate money supply, and they can raise interest rates, which reduces the flow of new money into the economy. Yeah. And so those are the three things he can do. And I think that he took, as we said in the earlier hour, I think he took a deliberate stance of independence for the Fed, and he kind of quelled some of the concern that he would be influenced by the administration. And so I think he's breeding confidence back into the Fed.
I keep thinking about that pressure that he must be under to show independence, but also you've been tapped by the president of the United States who wants you to lower the rates. Markets are now pricing in a much lower chance of July rate hikes. What does that mean for everybody at home who's thinking about, mortgage rates, credit cards, auto, just real life, everyday stuff that Americans are thinking about? What does this mean for us?
Yeah, real life. So over 60% of Americans are living paycheck to paycheck, which means they are relying on credit cards and debt to get them through, get these, even the heightened grocery prices, right? They're paying a premium in interest on that. And the credit card interest rates are astronomically high, some as high as 29%. And so what happens is when this 10-year fluctuates in anticipation of what the Fed's going to do, because remember, interest rates aren't solely determined by the Fed. They're actually traded. It's bond traders. When you sell bonds, the price of bonds goes down and rates go up. And so what happens is the debt service becomes harder on consumers. And that's what's important. Now, lowering interest rates isn't bad. Donald Trump is considering the federal deficit that we have to constantly, borrow money to cover. And so the rate of borrowing money or the expense of borrowing money is dependent upon the yield. So I know he wants to reduce the interest on the national debt and he wants to reduce rates in that way. But there's so many checks and balances because inflation hurts the consumer. Raising rates hurts the consumer because their credit card their credit cards go up. So this is a delicate
balance. A lot of
balance
hurt right now. Yeah.
It's a delicate balance,
Yeah.
not an easy thing to do.
Yeah. Well, Frances Newton, thank you for your insights this morning. We'll be watching again, Kevin Warsh today, day 2. Appreciate your time.